Good morning, ladies and gentlemen. Well, the risk dial closed at 73, still very strong, very much in the green. But underneath, if we have a look at the individual scores that happened last week, we will see that they are actually nowhere near as strong as the scores that happened further down, which were all in the 80s and 90s, which means there is something going on under the surface, but we are a very long way still from triggering risk off. Risk reward favors equities, followed by gold, followed by bonds. And bonds really are the most troubling, and we shall have a look at that next. The yield curve just keeps on steepening. You will see that this is a daily chart of 2s, 10s in the States. 1, 2, 3, 4 days of doing a little bull flag, and on Friday, boom, right at the highs. We really need to change this to a monthly chart, and this is it, to be able to see what on earth is actually going on. If we zoom out, we will see that we are really now in a territory that we haven't seen since 2015, and before that in 2012. We are basically going to 180 basis points, and that is an extremely steep yield curve. Whichever part of the yield curve we look at, the same story. If we look at 5s, 10s, we will see that that basically has broken. New lows for the week, and really there is very little support until we get into this area around 90 basis points here, and then ultimately 114 basis points. You can see how precarious a position we are in. It really is not good. 5s, 30s, my favorite part of the yield curve. I think we're holding in by the fingernails. In another weekly low through here, and I think we have nothing until we get here, which is around 150. This level here is 192 basis points. I mean, that's another nearly 40 basis points of steepening. This is getting very, very worrying, and I think the Fed is either telling us that they don't care and they want this to happen, or there is something that I don't understand going on, but this is going on. I'm showing you what is going on, and basically that is a return to levels that we were in 2013, 2014, 2012, when there was a very strong expansion going on in the economy, and I think that basically the market is going back there. It seems preordained. That tells me that certain sectors of risk are going to perform much better than others, and of course we will examine that later on, but you have to be aware of the very critical levels that we are in yield curve steepening, and the triggers that will have for different sectors in the risk sector. The move in bond markets is primarily a US thing. If you have a look, this is now a monthly chart of the differential between 10 years US and bonds in Germany. You can see that basically we are returning to where we were in 2017. I would have thought that this is preordained to trade around the 220 basis points level. So that's another 30 basis points of differential, of higher differential between bonds and 10-year notes. Basically, all these charts say avoid the long end of bonds in the States, especially in the States, because the yield curve is steepening, and B, as we shall see next, the chart of outright 10s and outright 30s is beginning to look absolutely awful. This is now the 10-year note yield. This move to me on Friday was very shocking when we went from 150 to 163 in a day, and a day when we concluded the auctions in the threes, tens, and 30s, and the market held in, and overnight we just broke. It seems destined to me to trade these upper levels here. This is 197 basis points, just below the 2 level. I think within 2-3 weeks, this is where the market is telling us it wants to go towards 2. And that actually gives us our objective in 2s, 10s. 2s don't move. 10s go to 200 basis points, and we have the spread that I showed you earlier in 2s, 10s. The 30s are just as problematic. You see this huge move that we had overnight on Friday. It really is very frightening. I think there is very little to hold it until these levels. This is 265, and my line is at 270. Basically, it says that 30 years are more or less gonna keep pace with 10s, and we get a parallel shift between 10s and 30s in the yield curve, while the 2s stay exactly where they are. Another 30 basis points to go. If we have a look at what that means for TLT, and basically what it means is that the first level, 136.99, has been decisively broken, and now we are most probably going to go and trade the most traded level, the average level for the past decade, which is 127.37. What does that tell you? That tells you that the market is saying basically the episode with the pandemic is well over, and we are now normalizing the curve very, very quickly, and we are saying that higher level, with the Fed wanting higher levels of average inflation, there is absolutely no reason to own the longer end, that the risks in the longer end are all still to the downside. The market will even overshoot that level. So basically absolutely no point in owning long bonds, and any kind of move back up, if we do one of these periods where we trade basically between the 132 and 141, 142 level, it's all still a sell. It's going to break down, and break down hard at some stage. You have to give up on bonds. The market has spoken. There is absolutely no point in owning bonds. I've been saying for a long time that the worst of the three risk classes, if you go for equities, followed by gold, followed by bonds, there is absolutely no point in owning bonds, it seems, and I don't think this is going to change for quite some time. Europe, as shown, is much more contained. This is the bubble. What is significant to me is that even with the very strong statements from the ECB and the very strong action from the ECB, we really couldn't rally. We keep on maintaining these levels of minus 65 basis points in the bubble. I think that if we were to see this kind of level, 68, 69 basis points, it would be a gift for put spreads on the futures, because really, the die is cast. We will see minus 48 basis points at some stage. If we look at Germany, at the Bund, you will see how that is evident that the yield curve is steepening. This was the price action on Thursday, on the statement from the ECB about their action. Boom, on Friday higher. basically cannot sustain. We will trade 22 basis points again for sure, and we will even break those. And that is how we get to those levels around well over 200 basis points differential between the 10-year note and the Bund. At some stage, it seems quite obvious to me that we will trade this spike level of 14 basis points. The Bund is just much more contained than the 10s and 30s in the States. With the differential in yields that is happening between Europe and the rest of the world and the US, it really is what the market didn't do that tells you a tale. Did the dollar appreciate last week? No, not really. We had the little spike up into the 92s that I predicted, straight back down and actually closed down on the week. And that is telling you the tale, that every time it gets up into the 92s to 93s, it's going to be a sell. Even on a daily basis, you can see how very weak these bounces are. It really is telling you a tale that all currencies might be rubbish, but the dollar is not really the cleanest shirt in the dirty laundry. I think that, I keep on saying that I don't see how the dollar can strengthen this year with all the funding they have to do. They have to keep the dollar cheap and give people a reason to buy all those bonds they want to issue without yields going to ridiculous levels. But I really don't. I think that the upside is very, very limited. Every time it gets up into the 92s, it's smacked back down. I think that at some stage we resume the trip lower to 88.44 and then down into 84.50. I think buying dollars is not a good strategy, and I really don't see why you would want to do that. There isn't a single chart of the individual currencies that I will that I've looked at that really tells me that the dollar is about to turn. Nothing there. I think that within a few days, if we enlarge this daily chart, within a few days we will be at a at a technical level. When we get to around 93 or so, and we'll have a very violent move down, back down towards 88. Absolutely nothing new with my friend gold. It's an avoid asset, just like bonds are an avoid asset. It's trading. It missed my 1658 level by a few bucks. Consolidated. Didn't break down with bonds on Friday, which I found interesting. But still, I'm having a very tough time seeing it above 1763, and certainly above these levels with around 1800 to 1810. It's got nothing going for it. Real yields are rising, and I can't see them stopping anytime soon. The dollar is going sideways. And unless that one starts really breaking down, I really don't see that gold can do anything but trade sideways to down, possibly fill that 1658 level, bounce back up towards 1764. To me, it has nothing going for it. If you look at it on a longer term chart, it could be doing an ABC retracement down towards 1630, 1620, might take another few weeks to get there. But if you think about it, when can gold start performing? Gold can start performing once bonds have reached their objectives. So when bond yields are no longer rising, gold becomes much more attractive wherever it is when that happens. So, because then you probably have the likelihood of a move down in the dollar. If you think about it, it is one should not expect the dollar to be making vast moves lower while the interest rate differentials between US dollars and the rest of the world are going out. When that stops, that is when the dollar can go down, and that is when gold can go up, because then it's going to have everything in its favor. It's going to have real yields not rising anymore, and it's going to have the US dollar going down. That's going to take time. So that's why I still think that within the next month or so, we trade down here in the low 1600s on this weekly chart, and then we will be in a position to start making some counter trend moves to maybe above 1800 again. But to me, this is an avoid asset, or rather a trade asset rather than a positioning asset. It doesn't take a genius to conclude that the different indices are trading at different levels, different speeds, and in different ways. And that is because we are actually returning to the situation that we had in the spreads at the beginning of 2020, and we are negating everything that's happened since then. And basically the market is saying the pandemic is over. Within a few months it'll be just a bad memory. What does that entail? If you have a look at what the transports are telling you, they are just not closing lower, and they are just crawling up the Bollinger Band. That is also evident in the Dow Industrials, and basically those sectors are the leading sectors. Until transports and Dow Industrials are ready to turn down, there is absolutely no hope that the S&P can follow them. That is all there is to it. So at the moment what we're having is, because of the higher yields, and yields are still going higher, we're having the high beta and high duration stocks getting destroyed, while the everything else is rallying. While this state of affairs keeps on going on, there is absolutely no hope for the S&Ps to turn down, and we shall now have a look at a few spreads against the S&P to see where things are most likely to head. This is XLF over SPY. This is where we started the pandemic, around the 94-95 level, and we are at 88. Is it unreasonable that we should return at the levels of pre-pandemic? No, absolutely not. Look at this level here, around the 94.75, 94. We have traded there so many times, all the way, in the past decade when things normalized. That tells me that XLF has still some room on the upside. This is XLE over SPY. This is where we started the pandemic. We are still, a good 7-8% lower than then. Is it unreasonable with oil prices in the 60s that we should go back there? Doesn't look unreasonable to me. Suggests that XLE over a certain period of time can still lead this market somewhat higher. And finally, this is XLI over SPY, and this is where we basically started the pandemic, and we are still not there. We need another 2-3% relative value between the two, and that's where we are heading. This would suggest to me that XLF, XLE and XLI still have room to take us higher in the S&Ps, and they have room to outperform the S&P. Now, how big are they? Well, when you put them all together, you get to about a third of the index. So what we really need is stability from technology, while these sectors lead us higher to get to a higher S&P level. It really is all in the hands of tech. If tech is stable, and tech is about a third, then we will get into the 4,000s very, very quickly over the course of the next couple of weeks. but it looks to me like the transports and the industrials are leading these markets, and they're leading them higher uh, on a relative basis, and we will get into the 4,000s. We'll get a last hurrah. What makes sense to me is that we start turning in all these spreads only once bonds have achieved their ultimate objectives, which I showed you earlier. And as I've said for quite a while the steepening of the yield curve takes place and the bonds go to the absolute yield levels that they are headed towards that I showed earlier and achieve those levels, the level of the S&P is really dictated by the level of tech. These are the spreads against tech, and what is actually interesting to me is that we are really not breaking down that severely. Okay, I mean, this move was definitely severe, and we can have a look on a daily basis. You can see that we went from 0.86 all the way down to 0.78. So we had a 10% plus move in the spread. But what I am saying is that we are very contained, really. We're still at the same level that we were in July of last year. And therefore, it doesn't look to me like tech is going to fall apart. We have had, let's call it 70% of the move that we're likely to have in bonds. So we are unlikely to go below and this chart is quite useful in that respect. We are quite unlikely in tech to go below the 0.382 retracement, which is around 31.52, as you can see here. And that is not a million miles where we are in the spread against S&Ps. That to me argues for relative stability in NQ. I mean, I don't think NQ can really start moving higher. I think it's more likely to probe lower over the course of the next few weeks while bonds achieve their ultimate target to the upside. But once it has achieved, I think that the swing in NQ can be particularly hard to the upside, and we can have a look at all those individual indices now. Let's take it in the logical sequence. If bonds are going to the objectives I showed, then the market which is at risk is NQ. While NQ is holding 12,238, it is relatively stable. And really, if it doesn't hold 12,238 on a weekly level, the obvious target is 11,058. Now, I know that that is a long way away, but if bonds are going to do what I think they're going to do, then that is not such a ridiculous level to do an ABC on a weekly and ultimately get there. But what I'm really saying is that I'm actually impressed by the way it held in last week, and that we are more likely than not to trade again 12,238 as a result of the bond move. But what is that going to do? If we have a look on the different time frames, 195 minutes, and on the dailies, if we have a look at the dailies, that tells you that all we're doing is going sideways to down, meeting the 200-day moving average and getting support from it. If that is the case, then we are going to go immediately higher in the S&Ps, simply because the other sectors will take it higher while NQ does nothing. For NQ to get bullish, we really have to take out 13,312, and I think that is going to be almost impossible. I think the market is going to have, little brief moves above it just to get you bullish, and then it's going to spit you out. That's what I think is going to happen to tech, a broad move sideways to down, because I just don't think that they can take another 30-40 basis points of steepening and 40-50 basis points of higher rates without at some stage having a nasty dump down, which will be most probably a very, very good buy. This is now a weekly chart of the Dow, and you can see how it's immediately bullish. Yes, we are up against the Bollinger Bands, but that will expand, 500 points or so. So we could easily see above 33,000 next week. There is, as I showed you, there is absolutely no reason to be short of the Dow, simply because the financials and the industrials are relatively stronger than the S&Ps, and the Dow is showing us the way. It's basically saying that it wants to go higher by another few thousand points over the course of the next few weeks, and why stand in its way? If we have a look at the 195-minute chart, I think there is very little danger of any kind of weakness in any of the major indices, unless the Dow, which is the leader, starts taking out 31,223. And I don't forecast that to happen anytime soon. But in any case, we have our level, and while it stays above it, this is immediately bullish. I think if all retracements are down to 32,000, we are going to be into 34,000 within a couple of weeks. And the poor S&P is a hostage of the Dow and the NQ. As long as NQ is stable, it'll follow the Dow higher. This is a weekly chart. As you can see, we went up far less than the Dow, but more than the NQ, and which makes sense because of the S&P's composition. We didn't manage to close right above the old high, but I think that is good enough. I think the likelihood, the odds are that we trade up into the 4,000 next week following the Dow, but it'll do it at a speed which is slower than the Dow unless the NQ helps, and the NQ can really only help if we have a major rally in bonds, in the long bonds. I think that is unlikely. Long bonds are oversold, so they could easily rally a point or so, and that would actually get us up into the 4,000 without any problem. What I'm saying is that there is absolutely no reason to fight this, simply because it's in whichever index leads it higher, whether it be NQ going to the resistance above 12,300 or whether it's the Dow being immediately bullish, the volatility of the S&P is going to be less than either. I think that basically any move down to 38.93 is going to be very, very well supported, and especially 38.61. I think the odds of seeing it lower than that next week are practically very non-existent. What makes me quite confident that we still have room in the Dow and in the old economy stocks in inverted commas is that some indices which have been dormant for a very long time are finally beginning to wake up. This is a monthly chart of stocks, and you can see we are coming out here out of a, what is this, a 7-year consolidation. When that sort of thing happens on a monthly chart, you tend to get moves which are of this kind of order of magnitude, 4,500. That's another 20% on in this European index. This is a big move, but you can see how far we are below the level he got to 2,000 when it was 5,500. So we have a lot of potential here. When this kind of pattern happens on a monthly chart and we start breaking up, it's nearer the beginning of the move than the end. And if you do a target of this, you will get it up here. Now, to me, it's inconceivable that you could get a 20% move in the stocks without having a considerably higher move in financials and in industrials in the States as well, and that to me indicates that the Dow will lead the S&P higher, and that when bonds have achieved their targets, then you might get some risk off, but not until then. It's going to take a while, and I think that Europe is going higher and leading everything else with it. While we're on that subject, I think it's unlikely that the States can turn down while this is going on. This is the DAX. I've just showed you the stocks. Clear channel, and the top of that channel comes in, 15,600, 15,700 in the next couple of weeks. I think it's extremely likely we go there within a month. And if we have a look at EWU, which is basically the UK, and this is a weekly chart, I think the likelihood is that we trade in this area between 34.10 and 38.26. It tallies very well with a ABC objective. I think while Europe is going to go, I mean, this is what is this, a 20% move? While Europe is doing this, it's extremely unlikely that the States doesn't follow it, or the sectors in the States that I've been looking at don't follow it, and rather lead it, and therefore, as long as NQ doesn't do anything silly, the S&Ps will perform quite well. In summary, I don't think anything is going to change until we have met our objectives in the bonds, and I think the yield curve will get to levels like 160, 175 in 5s 30s and 179 in 2s 10s, and that will be the time when things can change in the world. Until then, I think we will continue doing what we've been doing. I haven't really changed my levels in DXY or gold. I think 1765 there is all we have, but while we're above 38.93 in the SPX, I think there's nothing to stop us achieving the 4040s. It'll basically go up along the red in deviations. Download them every day and have a look where we are. NQ, that's the one that the speed of this ascent in SPX depends upon. These are the important levels. Only we start closing several times above 13,312 can it even be remotely bullish, but that will depend on the bonds. I just can't see that being sustained. And these are the new levels in TLT. I think there's very little to stop us going down to 127.37, and I think probably no bigger rallies than the 141s. But have a look at these market stocks and EWU. I think these are now going to explode higher for the next 2 or 3 months before we have achieved all these levels in the bonds, and we are then ready for risk off. It's a new world. We are being led by financials, industrials, energy. We are returning to the spread levels before the pandemic, and therefore these are the indices that should lead us there. Thank you very much indeed, and tweet you on Monday.